What's going on, MULN fans? Welcome back for another video. I'm going to try to make this first part of the video fairly quick because I do have some video clips to show you at the end on supporting my thought process on if MULN is actually trying to go private here in the near future, possibly. Today was yet another brutal day on MULN Automotive investors. I'm neither bullish or bearish, just to make that known. But I do care about if retail investors are getting taken advantage of behind the scenes and losing shareholder value on a consistent basis. With that being said, I do not own shares of MULN Automotive stock. There are still MULN investors out there that enjoy my MULN updates, so I continue to do so. Just to be clear, also about 2 months ago, I made that video there at the top announcing that I am exiting my position if MULN does a second reverse stock split. I did exit right before that second reverse stock split, which MULN was trading 80% or so higher at the time, now down 81% in the last 3 months. And the other two videos here on the screen was me talking about immediate dilution occurring after the last shareholder meeting, that 52 million company incentive plan, along with me talking about that last one, shareholder value. The electric vehicle maker is holding a special stockholders meeting December 15 to authorize its board of directors to effect a reverse stock split at an exchange ratio between 1-for-2 and 1-for-100. MULN said it expects that the primary focus of the board in determining whether to effectuate the reverse stock split will be the ability to obtain and maintain a continued price of at least $1 a share on the NASDAQ capital market without affecting the reverse stock split. The reverse stock split will only be implemented if necessary to regain compliance with a minimum bid price of $1. So if necessary, this will make a third reverse stock split in the same year for MULN Automotive Company. And I don't know why people are thinking that a reverse stock split at any point in time is good for the company. It only resets the cycle, the short cycle, bringing the stock price right back down once it gets to a higher price. It also dilutes the shareholders, which will have less and less shares at a higher price. And here's a guy named Chris over on Twitter that's been getting a lot of retail attention, saying a lot of bullish statements about MULN Automotive. He says, very bullish, MULN part of NASDAQ compliance package. Now expand buyback and reduce the float 50% and stock will reset. In my opinion, $20 per share. And this is what he's wanting people to think will happen following a reverse stock split if it takes place. Then shout out to Fate Wanderer 84 over on Twitter. He says, Chris, a third reverse stock split in no world is bullish. It's clear the negative things said about your intentions are apparent. You are just focused on making the company successful, even if no value in the stock is being brought to shareholders. No one should be giving you any more attention. I'd have to agree with Fate Wanderer personally myself, because shareholder value continues to get destroyed while David Mystery continues to get performance stock awards, issuing shares, and gifting shares to whomever he wants to, while shareholders are continuously being diluted. It's time for shareholders to keep it real, because enough is enough. There are still investors that have been through 2 reverse stock splits and are still defending David as if he doesn't owe shareholders his ass right now and his private jet. Now let's get into the going private talk. Now don't hate me for sharing this information with you. I just thought it might be vital to know about based off of MULN's current situation. It says a going private transaction generally involves the cash out of all or substantial portion of a company's public shares so that the company becomes eligible to delist and deregister its shares under the Exchange Act. With that being said, we're going to take a quick trip to Fintel and see the changes in ownership. You see the dates here on the side, March, February, and September of this year. We see percent changes going to 0, people selling out, negative 100% ownership. And if you scroll down some more, you'll see that there are a negative 100% all down the board as well. And you can see these are recent dates, September, October, going up to October 19. Now let's continue with the text. Going private transactions can take many forms and may involve a merger, tender offer, or reverse split of the company's shares. Going private transactions require extensive and detailed disclosures filing under 13E3. Going private rule. Going private transactions are often undertaken by or as the direction of controlling shareholders or third-party acquirers and require extensive board consideration, disclosure, fairness, opinions, SEC filings, and often a shareholder vote.
So, who provides the money? So you want to take a massive public company away from public hands. What does that mean? Away from the shareholders that currently might own it, into the private market. So who's going to pay for that? Well, there are lots of potential candidates, but recently, 3 have sort of hit the headlines, if you like. Big private equity houses. These are houses with access to large amounts of private capital from various sources. They're almost institutions that can provide private capital. Then there's the shadowy credit hedge funds. So again, specialists, experts in raising debt and appointing teams who can manage businesses that are heavily indebted. And then you've got sovereign wealth funds, sort of quasi-public-private bodies sponsored by governments, Saudi Arabia, Norway, whoever it happens to be, who have large amounts of capital available, looking for somewhere to invest and make a return. Now, there are other sources of this private money, but those are 3 quite big ones right now. So, what's the motivation again? So, you're a Richard Branson or a Michael Dell or even Elon Musk. Why are you talking even about the possibility of going out of public markets into private markets? Well, several actually. One can be longer time horizons. Some CEOs tire of what feels like relentless pressure to meet and beat targets. Now, that pressure feels even more relentless when you're not meeting and beating those targets, it will be fair to say. Secondly, expertise. There is a lot of off-piste expertise. It's a myth, that all the best brains are at work in the public markets. There are a lot of good brains at work there, but some of the best ex-CEOs and company experts and so on actually prefer to operate away from the public spotlight. And thirdly, as Musk put it, an end to negative propaganda and short selling. There can be a perception that maybe analysts and so on have got it wrong about your firm, and actually you want to move away from the threat of people betting against your share price and negative propaganda from whatever source. Now, just to take a recent example, a big one, in Dell's case, things seem to have worked out fairly well. Okay, opinions divided on this, but things have worked out fairly well. So by taking the company away from public markets, we've seen product strategies overhauled, new markets tapped, and improved market share. All right, so clearly there are some good behind-the-scenes work that can be done on companies that are taken out of the public eye, as it were. But, and here's the but, okay, this is not the panacea that it's sometimes sold as, if you like. So why not? Financiers may replace top management. If you approach credit hedge funds, for example, or perhaps they even approach you as a target, be prepared for the fact they may have their own specialists, their own top managers, and a CEO can suddenly find themselves potentially out of a job or subject to greater professional scrutiny from different sources than perhaps they were before. Number 2, restructuring and cost-cutting are common. I mean, let's face it, the 3 parties I mentioned are not just handing money out for free. They're going to expect improvements in the underlying business, and they may even expect to relaunch the business into public markets at a later date, more efficient, more tightly run, and so on. And thirdly, some of the changes they have in mind may or may not be funded with pretty big debt issuance. So as a CEO, you're going to be ready for the fact that your financial structure may change quite radically. You're going to be quite comfortable with that. So the bottom line is what exactly? What do we conclude from this? Well, the bottom line is this. Public markets do suit an awful lot of companies. Private markets suit others, okay? And therefore it's a judgment call as to which one is the more suitable source of capital for which particular type of firm. So public markets are being sort of hammered a little bit at the moment for some quarters, but actually they do offer flexible access to very, very large amounts of capital, flexible being equity, debt, a mixture of the two, and so on. And beyond a certain size, it becomes pretty difficult to raise equivalent amounts of capital off-piste, as it were. Number 2, the incentives for management are visible. And whilst, yes, short-term pressure to perform is bad news if you're not performing, if you are performing, delivering, and your remuneration is tied to that, potentially happy days. And thirdly, prestige and a higher profile are valued by an awful lot of CEOs. When it comes to raising more capital, nothing beats potentially good PR, good press across a broad swathe of the public markets.
What happens to my shares if company goes private? If a company goes private, its shares are no longer publicly traded on a stock exchange. The company may be bought out by investors or its own management in order to gain more control over the decision-making process. As a result, shareholders may be offered a buyout price for their shares, or the shares may be canceled and the shareholder reimbursed for their value. In some cases, shareholders may still hold onto their shares, but they will not be able to trade them publicly.